Welcome to the second video in this beginner's guide to investing in the stock market. In our first video, we looked at the two main types of investing approach, passive and active investing, and the two different forms of active investing strategy, which were value and growth investing. In this video, we'll look at where and how to find good quality stocks to invest in. So without further ado, let's start our journey towards building wealth with value stocks on today's investment store. Welcome to the investment store, the personal finance channel that reviews a diverse range of investment asset classes from stocks and ETFs through to real estate and cryptocurrencies. If you enjoyed this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the investment store community and hit the notification bell to ensure that you never miss an episode. Now with that said, let's commence with today's video. In this video, we'll be identifying value stocks through the use of a stock screener. Now there are certain financial ratios that help us to quickly assess whether a business meets the necessary criteria for a good value stock. In this video, we'll be looking at our top 8 ratios for screening a value stock. Don't worry, we'll try to keep this as simple as possible. Our first ratio is a company's price to earnings or PE ratio. The PE ratio measures how much a company is currently valued in the market in relation to its earnings. Now there are different ways of calculating the price to earnings ratio, but we find the simplest way is to take the company's market capitalization, which you can find on most finance websites like Morningstar, and divide this by the company's net income, which is the income after taxes, dividends, and interest. Now you may remember from your math lessons at school, a fraction comprises of a numerator and a denominator. Now for any ratio where the price is the numerator or on the top, we want the value to be low. Why? Because this indicates that the price is low relative to whatever the denominator is. And the denominator will be typically something like book value, earnings growth, or cash flow. And this is an indicator that the stock price may be undervalued. Now it's important to note that anything negative is typically a bad thing, because a negative value means negative earnings. Also, a very low PE can be a signal of a company that is about to go bust. So we need to consider some other factors before we use this as a definitive way of measuring value. The next important ratio is price to book. This ratio measures a company's market value against what it actually owns in equity. Price to book ratio is the market capitalization divided by the total assets minus total liabilities minus intangible assets. This ratio tells us if the business was to go bust, how much would we recover from selling its assets? And again, the lower the value, the better. Next, let's look at the operating and net margin. Operating margin measures how much profit a company makes after paying their operating costs such as production costs, wages and raw materials, but before paying interest or tax. This value is useful as it shows us how much profit a company can retain as a return on its sales. The other important profitability ratio is the net margin, and this takes the net income and divides it by the total revenue. Net margin tells us how effective a company is at retaining its earnings after all its expenses, including paying dividends to its shareholders. Profitability ratios are probably the most important for assessing the viability of a business. The next ratios we'll look at are return ratios. The first one, return on asset, is the net income divided by the total assets. Return on asset is a useful ratio which essentially measures how much revenue a company can generate from the assets that it owns. Now, as a value investor, we want to find companies that are trading at low price to earnings but have a high return on asset. This is what Joel Greenblatt refers to as the magic formula. Companies with this combination will most likely increase shareholder value and generally make investors wealthy. Number 6 is the return on equity. The return on equity is expressed as the net income divided by shareholder equity, which is essentially assets minus liabilities. ROE measures the profitability of a corporation in relation to stockholders' equity. Like ROA, it measures how efficient a company is at making money from its resources. The perfect scenario is if a company can generate significant profits from a low asset base or low investment, as this indicates how efficient a company is at making money. Number 7 is debt to equity. This is an important ratio to keep an eye on, as it considers how much debt a company has. A company's assets comprise of both debt and equity, in the same way that the value of your house comprises of your personal equity and your mortgage. Essentially, you want to ensure that a company has a reasonable level of equity and is not over-leveraged. Debt to equity is calculated as the total liabilities divided by the shareholder equity. Our final ratio is the free cash flow yield. Free cash flow yield is calculated as the free cash flow per share divided by the market share price. Now, as price is the denominator in this instance, we prefer this value to be as high as possible. A high free cash flow yield means a company is generating enough cash to satisfy its debts and other obligations, including dividend payouts. It can also indicate that the share price is cheap. Now, you do not need to memorize all 8 investment ratios in terms of how they're calculated, but it's important to understand how they're derived, as this will help you in your investment selection and decision making. It's also important to note that whilst these ratios are all key indicators in determining a value stock, they should never be considered in isolation. And during this beginner's guide series, we'll take you through the process of analysing a stock in a thorough way. So, now we have all our ratios, we'll now go through a stock screener to shortlist some good value stocks. Our stock screener of choice is TradingView. We like this stock screener because you can customize the views to your liking, and it's also free of charge. Now, as anything that comes for free, it's worth noting that you will get more options with the paid option, and not every free stock screener does everything, but we find that the TradingView screener offers good value and provides most of the investment ratios that you need. So firstly, let's start filtering the ratios that we've been through. We'll first filter the current ratio, and for this we will select a value that is above 1.5. For debt to equity, we want this value to be below 1.5. We'll now search for some of those return ratios, and let's take the return on assets and make this equal or above 10, and the return on equity above 15. Let's now look at the price ratios. And let's first take the price to book. For this, we'll put a value below 5. And for price to earnings ratio, we'll take a value below 15. Now, it's worth noting that TradingView do not provide a free cash flow yield ratio as part of the free screener, but they do have the price to free cash flow ratio, which is effectively the inverse of a free cash flow yield. As it's the reverse of the free cash flow yield, we want this value to be low instead of high as we did for the free cash flow yield. So we'll give this a value of 25 or below 25. Now, once we've applied that, you'll see that our stock screener has gone down to 35 stocks on the US stock market. We've arranged our screening interface to capture all the ratios of our choice. Now, as we scroll down the list, you will notice some well-known names like Cisco Systems, for instance, and Intel. So as they've passed our screening criteria, we will take these companies and analyze them further in the next video. We also pay close attention to the UK stock market. So first we'll save any changes that we make to our screener options and apply the same screener to the UK market, where we find 12 matches. Now, when we looked at the UK companies, a company that grabs our attention is Ferrexpo, or FXPO, who fulfill most of the criteria, very low price to book ratio, and you'll notice that their share price has increased from 107 pence to 202 pence since March. And this is an indication of value stocks. They do not remain value stocks for long, so you've got to identify the value and invest before the share price goes up. Another example is Anglo-Asian Mining, and again you can see their share price went from 88 pence to £1.61 at its peak. It's come down a bit now, but once again it highlights how value stocks can make you significant returns if you catch them at the right time. Let's look at another stock that's caught our eye. There is the Sylvania Platinum Limited, where you can see the price to book at 1.19, very low debt and high current ratio, a high price to free cash flow ratio, or reasonable price to free cash flow ratio, I should say. And if we look at this stock in Yahoo Finance, again, if we look at the history over the 1 year, which we'll just select here. Yeah, we can see that from a low in March of 32, the share price has doubled. So in summary, this is how to find good value stocks on the stock market. And it's how we begin our journey in the investment store. Now, on the next video, we'll analyze some of these stocks that we've shortlisted and take them through the investment store 4-stage approach to determine whether they qualify as value stocks to invest in. Thanks for watching. If you enjoyed this video, please leave a like and let us know what you think about our approach. If you'd like to learn more about how we analyze assets, then please subscribe to the channel. We look forward to seeing you on the next video.